In this video, we'll continue coverage of Chapter 11, and then we'll have a chance to begin discussing some of the questions and problems at the end of the chapter that will help hopefully round out our understanding of some of the concepts that we discussed earlier. So, some of the last and closing concepts in Chapter 11 relate to distributions. Now, Roth IRA distributions, as we said earlier, are generally not taxable. Earnings are taxable, however, if they're withdrawn within the initial 5-year period of the fund. That would be an exception to taxability on IRA distribution. Otherwise, they're not taxable. For Coverdell Education Savings Accounts, these distributions I mentioned earlier are tax-free as long as they're used to pay qualified education expenses for the beneficiary of the fund or the account. And we cannot double up on tax benefits for any tuition or education expense dollar that we pay. So we can't, for example, take funds from a Coverdell account and use those funds to pay tuition and then at the same time use the tuition that we paid to qualify for a Hope or Lifetime Learning Credit. We can combine them as long as we don't take the same credit for the same dollar of education expenses paid. For example, if I paid tuition from funds from my Coverdell Education Savings account, then I cannot also take a Lifetime Learning Credit or a Hope Opportunity Credit against that tuition payment. But if I pay additional costs that are not taken from the Coverdell Education Savings account, then I certainly may qualify for a Hope Credit or a Lifetime Learning Credit because those funds would have received no other tax benefit. Funds that are taken out prematurely from IRAs, for example, are subject to a 10% penalty. There is a list in Chapter 11 on page 1119 that lists some exceptions to this rule, where you can take out funds, for example, to pay disability costs from an IRA and not be subject to the 10% penalty. Also, we can roll over funds from one retirement account to another as long as that rollover is executed within a 60-day window. We've talked about annuities a little bit, but an annuity is a series of payments pursuant to usually like an insurance contract. Sometimes banks will offer these and others. Normally, annuity payments are partially taxable, and the part that's taxable is usually the earnings part of the annuity payment. So when I start receiving, for example, distributions from my annuity account, my annuity contract, I'll receive maybe $500 a month. Well, part of that $500 will be based on earnings over the life of the contract, and that is taxable income. Part of that $500, however, it will be from my original contribution, my purchase of the contract. Well, that portion of the $500 payment or distribution is not taxable because we're not taxed on our distributions to the fund. Make this a little bit bigger here. And the expected return on the entire fund is going to be the addition of what we've contributed and what it has earned. And we'll go through some of the ways in which we can calculate the expected return, since the point of our death is often, of course, unknown. Then we need to use some assumptions, and we'll be using some life expectancy tables that are listed in Chapter 11. And that's a great segue into discussing then some of the problems at the end of the chapter. So let's look at the first question I have on my list here, which is multiple choice question number 31. That's found on page 11-33. For those following along, I'm at the bottom of 1133, where Thomas is self-employed, under 50. His earnings from self-employment before the KEO deduction, but after deducting 1/2 of his self-employment tax, for example, Social Security and Medicare, is $80,000. What is the KEO contribution? Some of these calculations are a little bit complex, so feel free to run through them as many times as you may need to. But then the first one, we have to set up an algebraic expression, because we need to determine what his income is after deducting the contribution to the KEO plan. And so the $80,000 is already net of the self-employment, so we're fine there. But we still need to apply the 25% rule to the $80,000 less the KEO contribution. We know that the contributions are maxed out for the KEO plan at either 25% of the earned income after self-employment tax and after the KEO deduction. So we compare that to the $55,000, and whichever is lesser is our maximum contribution that we're permitted in this year. Well, we have $80,000. Again, that's net of the half of self-employment tax. Then we have to take out the 25% times the amount of earned income after deducting the KEO. So 80,000 equals 1.25x to solve algebraically. X is equal to 64,000. So now we're going to compare 25% of 64,000 or 55,000, the maximum amount that's given in 2018. And the lesser of the two then is 16,000, which is 25% of 64,000. So the answer for number 33 then would be 16,000. And of course, feel free to adjust any of these values that are incorporated into the initial shaded cells. And let me just pull up that for you here. So in the kind of the light green colored cells, feel free to experiment, play around with some of these values to see, for example, how it will affect. Now the age, of course, in this case, his age is 50, so that it wouldn't affect the calculation. But what would affect the calculation is if you change the income to maybe 75,000. And you can see how that impacts. Okay, now the maximum contribution is 15,000. You can kind of run through the calculations to test that. All right, well, let's look at another one then. Again, that one related to KEO plans. Let's look at number 36. Number 36 is found on the lower part of page 1134, where Jack is single, age 53, AGI of 67,000, active participant in his employer's plan. So what is the maximum deductible IRA contribution he can make in 2018? Okay, so here we have a great example of a potential phase out. And one thing we need to look at is his age. And he's over 53 years old. AGI of 67,000, and that's going to be, of course, that's greater than the $63,000 threshold. So his maximum contribution, because he's over 50 or over, his maximum contribution before phase out is $6,500 to his IRA. However, because of his income and he's single here, he's going to have a phase out. And it's going to be phased out at the amount that it exceeds 63,000 divided by the range. And so let me pull that up here. And the range in this case is $10,000. So we'll take 67,000 minus 63,000 divided by the range given in the text, which is $10,000. And then we're going to multiply that by the 6,500, the full amount he would otherwise be qualified for. That's going to give us the disallowed amount. So if we want to know what the maximum contribution is, then we need to take the 6,500 and deduct the 2,600. And that will give us the maximum allowable deductible contribution. So again, there the phase out would have reduced the amount that he can claim a deduct based on his contribution. So he can still deduct the full $6,500. It's just that only $3,900 will be deductible. Okay, let's see if there's another one here. Number 37, we have to actually read kind of carefully. Question number 37 on the bottom of page 1134. Patricia, single, age 26, reports age of 67,000. And then it goes on to say, she is an active participant in her employer's plan. What is a maximum deductible Roth? Well, we can ignore everything else in the problem because none of the contributions to a Roth are ever deductible. So that's automatically going to be 0. For number 42, here we're asked to determine the amount of qualified expenses. So I've just listed all the expenses given. First of all, the transportation to and from the parents' house are never considered qualified education expenses, so those are out. The room and board would have been in had she been half-time or more a student, but she's not. So we have to exclude the room and board. So then the total of the qualified expenses would just be the $8,000 for tuition and the $1,000 for costs of related texts. And that would be it. Down to, let's see what would be, let's go to number 43, because we can demonstrate this simplified method I mentioned in the earlier video. So number 43 is found at the very bottom of page 1135. Here we have one is single, retired on January 1st, 2018, age 62, entitled to receive monthly payments of $1,500 over his life. The payments begin January 1. He contributed $71,500 to a prior plan. Using the simplified method, how much of the payments will be included in his 2018 income? All right, a couple things to look at here in number 43. I'm just going to make this a little larger here. Again, we're focusing on 43. I just entered the information given. First of all, I need to know what the total amount of the anticipated amount to be received at the very end. And I'm just going to take the number of anticipated payments, and I'll talk about that in a minute. And I'm going to multiply that by the amount of the payment. So it'd be 1,500 times 260. 1,500 times 260 is 390,000. That's going to be the total anticipated amount I'll be looking at. So let's look at a few things here. First of all, where did I get the 260 from? Anticipated number of monthly payments. Well, I need to go to the table, and again, I need to know that the age of this retiree, which is 62. So we will go to the table, and if you go to, get the page number here real fast. If you go to page 11-16, page 11-16, I'll just print that out here. You'll see some tables, and so these are tables over which we can anticipate the number of payments based on age, and these are monthly payments. So he falls within the 61 to 65 range, or 260 payments. So that's where I got the 260 from, and I just multiply that by the 1,500, and that's the total amount expected. Now the next line item in calculated amount in gray is 275, and here I just took the amount contributed and I divided it by the number of anticipated payments. So 71,500 divided by 260. And this gives me then $275. So that's the amount of payments to be excluded from income under the simplified method, just the 275. Finally, the amount of payments to be included in income and therefore taxable under the simplified method. Here I'm going to take then the $1,500 payment, and I'm going to deduct the $275 I just calculated, because that's based on contributions, which is never taxable, and I multiply that by 12 months because we're dealing with the annual amount here. For 2018, it said. So the total amount that would be taxable would be $14,700. So these tables then are really are life expectancy tables that we can use to determine how much of each payment is taxable. So the amount that's attributable of each payment to the amount contributed is not taxable. The earnings to get up to the $390, that amount is taxable. Okay. So, and again, that's based on 1,500 times 12, and of course minus 275 times 12. Or you could configure it as the 1,500 minus 275 times 12. That's the annual amount that would be taxable. So this is taxable. And then finally, number 46. Number 46, which is found on page 11-36. Where Juanita is 62, received distributions of $9,000 from her IRA. She made non-deductible contributions of $20,000 to the IRA. What is the value of the IRA? The value of the IRA, is given at $150,000. So what is a taxable portion of Juanita's distribution here? Okay, so a couple of things for number 46. First of all, I don't need to go to the tables to determine her life expectancy in this case because I am given the value of the fund at the end of 2018, so the expected value is $150,000. Now, this is what's interesting about this particular question based on what is given to us. The $150,000 is the value at the end of 2018, but we need to know the value at the beginning of 2018. And that'll be the $150,000 plus the distribution that was made of $9,000. So we need this $159,000 to move forward in our calculations. Okay, so get back to the beginning of the year value, which is $159,000 after before the distribution, $150,000 after the distribution. Okay, so we've got $159,000. We'll just say this is on January 1. And this will say is the value at December 31st. All right, now the question is how much of these payments are to be included in income and are therefore would be taxable? Well, we need to calculate an inclusion and exclusion ratio. I mean, that's one way of doing this. And I did it this way because I wanted to make it clear what is taxable, which is inclusion, and what is not taxable, which is exclusion. So how much is not taxable? Well, it would be based on the amount of the contributed, right? Because she didn't receive any tax benefit for the $20,000 she contributed. Well, that part of this payment is not taxable. So $20,000 divided by the $159,000 total value, projected value, as of the beginning of the year, gives 12.58%. Therefore, 1 minus 12.58% would be the inclusion. That is to say that 87.42% of the payment of the distribution will be taxable. Close that out here. All right, so if we look at this then, we have 9,000 times 87.42% or 78.68. That's the amount of the $9,000 that is taxable to this annuitant. Let's take a look, and this is actually number 46, to be more precise, is the recipient of a distribution of an IRA. Now, if we look at number let's see, let's look at number 50. I was going to end at number 46, but it might be worth taking a look at number 50. And I'll scroll down so you can see number 51 in case you want to stop the video later and do 51 as well. But let's just take a look at 50, because 50 is slightly different. So question number 50 is found on the top of page 1137. Monthly benefit of $1,500. Here we're going to look at the age of the younger annuitant in this case. So we have June is 76, Augustus is 78. So when we're trying to determine the expected return on the contract, we need to be looking at June's age because she is the younger, and therefore that's the maximum lifetime benefit will be based on her age. Now, this does use Table 5 on page 1129. It says the annual expected return multiplier of the younger annuitant. So if we go to page 1129, which is the end of the chapter, there's Table 5, where we have the ordinary life annuities. She is 76. So if you go to the table at 76, you see that we have a expected return multiple of 11.9, and that's years. So then the expected return on the contract is going to be the monthly payment of $1,500, and up to that I'm going to multiply the 11.9, and then I'll multiply by 12, and I'll get $214,200. Because this 11.29 is an annual number, and we need to make that a monthly number. So we just multiply that times 12. And that's why I included the multiplying times 12 in this formula, because this is an annual estimate from the table, and I'm dealing in monthly payments and monthly amounts. Okay, so I needed to convert that 11.9 from the table into a monthly value by multiplying by 12. If you have any questions on these or other problems or multiple choice questions in the chapter, please let me know.